Okay guys, so welcome back to the desk. We just spent the last two videos going through expected portfolio volatility. So what did we do? We talked through some concepts and parameters of portfolio volatility first, and then Chris took you through the calculations, the spreadsheet exercises in video 9, all the calculations that you need to use to calculate expected portfolio volatility for your own portfolios moving forward. Now, there's a few points to make here. So through distribution of returns, through ATRP, and through implied volatility, we again saw that the 1 to 3 month time horizon with long-short equities portfolio management is the way to go, with an absolute return mandate. So, making money in both up and down markets. We are also active because we are active managers. We're portfolio managers. We are traders. So we have an appreciation of the market and the market being dynamic. We have an appreciation that risk is dynamic through volatility, and we monitor the VIX. And in our long-short portfolios, what do we get? Well, we lower volatility. So we have two competing situations here that we have to always be mindful of. Firstly, we have a desire to get outsized returns. Who wouldn't? We all want to make as much money as possible. But we also have a desire to keep our risks under control. So what do? Well, we saw in our portfolio volatility videos that we can literally choose the level of annual portfolio risk in the underlying portfolio that we want to take. And given that amount of risk, given the amount of volatility that we want to accept in the portfolio, we have a target annual return for the portfolio from the risk that we're taking. And of course, we want to get the highest possible return for the lowest amount of risk possible. This is our Sharpe ratio. So we not only want to be just making money on an absolute basis, we want to also be efficient and optimal portfolio managers, optimal traders. So we can do this in a number of ways, utilizing diversification. So we can do it in stocks portfolios with leverage. In Europe, that means using contracts for difference, so CFDs, on around 4 times leverage. And in the US, we're using 2 times leverage for stocks portfolios, but there is also a different dynamic. We can use in the US stock options portfolios, which is obviously a very different dynamic, and that is a whole new conversation covered in the POTM video series in the suite of courses at ITPM. So now, at this stage, you should be beginning to see how everything fits together. You've got all of the tools that you need to not only see the difference between pro traders and retail traders, you now have all the main tools to implement in the same way that pro traders do, but in the retail trading infrastructure. Now, remember, this video series is only an introduction. The clue is in the name. Introduction to professional level trading. It's an introduction, guys. So you still have a lot to learn. You have to learn now how to be able to actually generate trade ideas. This is in the Professional Trading Masterclass video series, the PTM video series. You also still have to learn how to structure trades and build options portfolios. That is in the Professional Options Trading Masterclass video series. And you still have to learn preventative risk management. So the techniques of preventative risk management, that's in the POTM video series and the PTM video series. And you still have to learn how to actively manage a portfolio. That doesn't come from theory. That comes from implementation. You actually have to do it with real money, and you have to be live trading, taking real risk. Now, you can either do that on your own. That's totally fine. Or if you're struggling, you should absolutely do a mentoring program at ITPM, where our mentors will literally trade live with you for a period of time, and you'll start to see how everything works in practice. And of course, we're not finished with the IPLT video series. You still have to test your knowledge. You have to do the exam at the end of the video series and see how you get on, see how you score. Let's see if the information has stuck. Let's see if the information, you've digested it well and you understand it well. So here in video 10, we're going to piece everything together for you, so you have a full understanding of what you have learned before you take the exam. But of course, there's going to be further down the line a lot more work for you to do to get yourself up the competency hierarchy. So let's go over everything here in video number 10, and I'll be back at the end of this video with a few words. Okay guys, so welcome back. Welcome to video number 10. We're going to be looking at conclusions and next steps. Now, we've come to the end of the video series, and well done for getting this far. It's a hell of a lot of information to take in, especially if you've never ever seen anything like this. But a few things should be happening to you now. Things should be starting to sink in, and you should be starting to climb out of unconscious incompetence. But let's go right back to the beginning. Let's piece all of this together for you, okay? Let's have a look from the beginning at what we were trying to set out to achieve. What was the objective? Well, it was to provide a framework that allows retail traders to emulate consistently profitable professional traders, so you can benefit from the same approach. Now, with that aim to make retail traders consistently profitable, this framework, the professional trader framework, has to allow retail traders to utilize the same approach that's taken by profitable professional traders in their own retail brokerage accounts. And the framework itself has to allow retail traders to implement the processes within the framework on a weekly basis and realistically fit it into their normal everyday lives. And what we've done is here, guys, is we've started you on that path with the IPLT video series. The framework starts with really understanding a few things. Firstly, the differences between retail traders and professional traders. And secondly, volatility. To move on further, to understand more details of the framework, of course, you have to continue your path of learning. That comes in the form of additional video series programs with ITPM. But let's keep summarizing the first part of this framework. How we got started in making you understand the framework itself. Well, we started understanding the landscape of the industry, understanding the differences between retail traders and professional traders. Retail traders globally totally misunderstand what a professional trader actually is and what they actually do. New retail traders have to be aware that you're joining a very mature and sophisticated industry that's full of intelligent, hungry, and ruthless individuals, teams, and organizations. We went through this right at the beginning. Buying a book on Amazon for $20 is not going to cut it. Okay, guys, you're not going to walk into the trading industry and start making consistently profitable returns on a very, very long time horizon. It's just not possible, guys. That's not going to make you a good trader. What else is not going to make you a good trader is by listening to people with conflict of interest, okay? The brokers and the educators have the conflict of interest, and even worse, they don't even have the professional trading experience. So it is the blind leading the blind. We have to take the very first step, which is understanding what professional traders actually do, okay? To eliminate this perception and this misunderstanding that retail traders globally have in what professional traders actually do. And why does this matter? Well, this is a familiar screen to you now. Never do this, okay? This is the pathway in the modern world that retail traders take. Typing into Google, learn how to trade stocks, Forex, options, cryptocurrency, etc., etc. Where do you end up? You end up in a web of deceit and lies. And what does that do to you? Well, it just keeps you at the bottom of the competency hierarchy. It keeps you unconsciously incompetent. You keep going around in circles, just constantly remaining at the bottom of the pyramid. But how do you break out from it? Well, we introduce you to the first step. The differences between pro traders and retail traders. And we realized that when we compare these differences, we have to compare the function of hedge fund managers and the pre-Volcker proprietary trading function of an investment bank trader to the retail trader profile, okay? Retail traders trade with their own money, okay? The objective of the retail trader is to make money trading, obviously, but utilizing their own money as capital. So it's got to be totally logical for retail traders to compare the most successful professional traders that utilize their own capital and attempt to emulate their strategies. Those strategies is what we're trying to emulate. The only problem is, and this is why everyone stays in the retail trading world at the bottom of the pyramid, the only problem is all the misinformation and conflict of interest that exists in the retail trading industry around the world. The vast majority of retail traders do not know these strategies, let alone how to implement them. There's just not access to it. How do you access hedge fund managers and get to know their strategies? How do you access pre-Volcker investment bank proprietary traders and understand their strategies? Well, it's very, very, very rare, okay? Generally speaking, it's not available. It's only available in very, very small minority cases, like with ITPM, because we've been on that side. We know exactly what goes on, and we implement these strategies ourselves. So what are the differences? What are the differences between professional traders and retail traders? Well, we've got a whole bunch of differences here on the screen, and we've added some at the bottom to the original slide. Because as we've gone through the video series, we've picked up more differences and nuances between professional traders and retail traders that are very important for retail traders to understand. So let's go through them. Expectations management, okay? There's a big difference between pro traders and retail traders in their own expectations. Professional traders aim to get rich slowly over time. And they know that their approach must include measures ensuring that if anything goes wrong in the portfolio, that they will still be in the game. Their aim is to trade from now till the end of their career. Retail traders' expectations are very different. It's about having quick wins, quick hits. And what does that lead to? Usually it leads to blowing up their account. The expectations of retail traders is that they're either going to win big or lose big. Professional traders don't even get involved in that. We aim to get rich slowly over time. How do we do that? By compounding returns. It's all about compound returns. As pro traders, we're aiming for consistent risk-adjusted returns that are compounded over many years to generate growth in the trading account and to create
wealth in the long term. We aim to be steady players with a solid track record. Why? Because we are using the litmus test that outside investors will invest in us. Okay. So it's a good test to give yourself as a retail trader. Think about stepping outside yourself for a moment and asking the question, would somebody, a third party, invest money in my trading strategy? In the vast majority of cases, if you're intellectually honest with yourself, the answer would be a flat no. You don't even know the level of risk you're taking. Your returns are wild. You're far too concentrated. You blow up over and over again. No one would invest in you. So the next question is, why would you invest your own money in that strategy if somebody else, a third party, would reject it with a flat no? It's just lunacy. So as professional traders, we do not get involved in anything like that. It's about consistent risk-adjusted returns and increasing wealth over time. Another difference between professional traders and retail traders. Professional traders, we know that there's no such thing as income from trading. We don't even aim to take an income from trading accounts, whereas retail traders genuinely believe that income from trading is a reality. It's not. Trading is not an income strategy. A trading account is an asset. It's an asset in itself that sits on your balance sheet as a human being. And your job is to grow its value. It's not to take an income from it. In terms of income source, all professional traders know that they have to have an income that is additional to their trading account to pay for their life, to pay for everything outside, okay? To pay for their day-to-day expenses. A professional trader never takes money out of their trading account because they seek growth in that account and seek wealth creation. Retail traders, for whatever reason, and it's obviously to do with the misinformation, retail traders believe that a trading account is for income. Professional traders do not. Now, we've added a few additional differences, seeing as though we've now been through the entire IPLT video series, and you can understand what it actually means, okay? Absolute return mandate and risk reward profile. With the returns mandate, professional traders want to get absolute returns. We do not measure ourselves in long short portfolios against the market return, okay? We are looking to make money when the market goes up and when the market goes down, okay? Alpha is not important to a long short portfolio manager. Just making money all the time by taking a level of risk that is higher than the market risk is the aim. Okay, we want to make money in up and down markets, and we want to make way more than the market return. So it's about absolute return in either direction, up and down, and making a big amount of money. And when making that money, not pegging yourself against the market return, not worrying about it. Alpha is not important to a long short PM, whereas it may be important to long only managers. It's not important to us. We just want to make money in all market conditions. Okay. But how do we make that money? Well, we're long short. Okay. But we're aiming to get a higher percentage return than the level of risk that we're taking. So the highest amount of return possible from the lowest amount of risk possible. So we're maximizing our Sharpe ratio. And of course, making money regardless of whether the market goes up or down. So in the absolute return mandate context. And we're aiming for consistent profitability from now till the end of our trading careers. Retail traders, unfortunately, take a totally different approach. This to them is a totally different language. To retail traders, pretty much all of them, 99%, have never even really heard of this stuff, let alone know how to actually implement it. Okay. So as you should know by now, The differences between professional traders and retail traders are vast. Vastly different, guys. Very, very different. But the question is how are you going to get out of incompetence and join all of the professional traders and super smart retail traders at a level of competency? Well, let's start with the level of unconscious incompetence. You've got to drop your old ideas, guys. You have to drop your old ideas. You can't even begin to climb the competency hierarchy in the trading world unless you recognize that the old ideas you had do not work. Of course, you may have experienced some fleeting successes, but overall, over a long period of time, over many, many trades, it's not going to work. This is because you're not taking a sustainable approach, the professional approach. So step one is dropping your old ideas. You should be in the process right now, having gone through the IPLT. You should be starting to drop your old ideas. If not, rejecting them flat out. Okay. The next level is conscious incompetence. Okay. This is where you've woken up. This is where you should be now. At the end of the IPLT video series, you should be at conscious incompetence, understanding the differences between pro traders and retail traders, how pro traders approach the market, and all the tools that they use in step one to underpin that approach. It's all to do with volatility. We're going to come onto that again soon and summarize it properly for you. But conscious incompetence, let's understand that first, okay? Conscious incompetence, understanding that sustainability in trading means consistent returns, which can only be achieved through a robust and repeatable systematic process. And what you've actually got to do to do this and stay at conscious incompetence and not drop back into your old habits, okay? You've got to first learn the theory of this systematic process. And that's going to keep you at the next level. So you first learn the theory of how professional traders select their trade ideas, how they time their trades, how they structure trades, and how they build portfolios and both preemptively and reactively manage risk. That's going to get you to the next level. And that's in additional video series programs at ITPM. Then, once you've learned the theory, you have to implement profitably, okay? You have to do this with real money and implement it profitably. That's going to get you to the next level where you've become consciously competent. You've now entered the realms of being a competent retail trader or competent trader overall, okay? Implementation and implementing profitably. You have to properly commit to the process and implement it in a live trading account with real money. Demo accounts don't count. You cannot become a competent trader by not trading real money. Of course not. You've got to achieve a positive, reasonable return over a number of trades over a period of time. It takes about a year, guys. Okay. You can become fairly competent in 6 months, but in reality, you've got to get a decent amount of trades under your belt, probably minimum 100, possibly up to 200 trades in volatile periods. So between 100 to 200 trades, usually it's going to be around 125, 150, and you have to do this over a year as minimum. You can get competent in 6 months, but the true test is actually doing it over a longer period of time. Okay. Now, if you do have difficulty bridging that gap between theory and implementation, you do need to seek professional mentoring. You need that guide sitting next to you, looking over your shoulder, monitoring your actions and telling you why your actions are wrong, why your actions are right, understanding how to generate amazing trade ideas on repeat. You need someone guiding you because clearly there's a breakdown between the theory and implementation. Okay. the weekly schedule that you run in terms of your hours and the quality of the work that you put out has to be repeatable and sustainable. So a professional mentor would also help you with that as well. Okay. Then you're on to the next level, which is the unconscious competence level, where you're essentially on autopilot mode. The level of unconscious competence is basically when you've hit the numbers. You've hit the numbers, traded over a certain period of time, say around a year. You're starting to go into the second year. You've hit the numbers that pro traders really need to hit in order to claim that they're competent. Okay, they're competent traders. And now you're starting to get very used to the processes. They work very nicely and fit nicely into your life. And you're on autopilot mode going into year 2. The management of your trading account, the growth that you're getting from it, and the weekly processes that you're implementing become natural. You're doing it without thinking too much. You're generating high quality ideas on a weekly basis, and you know how to build and manage your long short portfolio successfully. You know what to do when things go right, and you know what to do when things go wrong. And you take all of these outcomes in your stride. Essentially, at this level, you are professional standard level, but you are existing in the retail trading infrastructure. Now, in terms of the learning curve and the IPLT video series, becoming consistently profitable, becoming as good as a professional trader, but existing in the retail infrastructure, you have to really understand the approach that professional traders take. What is the time horizon that they're looking at? Well, we're not going to labor this point too much here because you can always go back to previous videos to understand it in more detail. But essentially, we are in the 20 to 60 day time horizon. We are 1 to 3 month volatility traders. And this is where retail traders don't exist. Retail traders always exist in the very short term as retail day traders or 1 week traders, or they exist all the way on the other side of the spectrum as retail investors, so income and value investors. What retail traders fail to understand, because they don't have access to this information, is that there's a whole world in between. And that world in trading, not investing, in trading, is the 20 to 60 day, 1 to 3 month time horizon. And this is where the vast majority of professional traders exist. We exist in this time horizon, and we take a long, short approach. This is where you get the best disciplines of trading and investing. Why? Because you're learning fundamentals in the majority, and then you are operating in a time frame that is a trading time frame, not an investing time frame, or an extremely short trading time frame that is full of noise and not fundamentals. And at any time in your career, when volatility moves, you can go up and down. You can slide up and down the scale. But the 20 to 60 day time horizon, 60 days is the limit, with a gray area of between 60 and 120 days, where even if volatility is very low, we still look to trade out of positions within 60 days. We don't seek to become investors, okay? And then if volatility rises, we can, of course, slide down the scale, the time horizon spectrum, and become much, much shorter term traders. We can become 1 day traders, and we can become 1 week traders. It all depends on volatility, but we never, ever become investors. We are traders. There is a big difference, and retail traders genuinely don't understand the difference between the definition of trading and the definition of investing. And they mix up these strategies in their account, and they're just all over the place. So with volatility, most of the time we are operating in the 20 to 60 day time horizon in normal conditions, in normal volatility conditions. When volatility increases, we can become shorter term traders. When volatility is low, we still max out at 60 days. For retail traders, coincidentally, this is the retail trading volatility and learning sweet spot. Okay. Why? Because you're learning the best disciplines of fundamentals, technicals, price action, and timing. Okay. Now, in terms of the systematic process that pro traders use, that long short portfolio managers use, what is the systematic process? We've been through all the details. Again, you can always go back and go through the details again. But essentially, we are split up into two big parts, theory and implementation. Okay. When we are selecting our trade ideas, okay, we're doing research work. We're doing both quantitative processes and qualitative processes rooted in fundamentals. We figure out what our bias is in a particular asset, in a particular stock. Okay. Are we fundamentally bullish? Are we fundamentally bearish? We figure that out through quantitative and qualitative processes. And this is literally 80 to 90% of our entire work when we're generating an idea that evolves into an actual real position. Okay. And in terms of the process, timing is 10 to 20%. We're using technicals and price action for timing only. And this is a big difference between retail traders and professional traders. Retail traders, through misinformation and miseducation, have the perception that traders are extremely short term and we generate our trade ideas using charts and price action indicators. We don't generate trade ideas from charts and price action indicators. We use those tools only for timing once we have a fundamental predisposition of bullish or bearish. And then we use those indicators to try and time our trades slightly better. We do not use charts and price action to generate trade ideas. Now, once we have a fundamental predisposition and we actually think the timing is good, that's when we have to think about actually having a position. And then we start thinking about catalysts and trade structure. Okay. A trade idea is not complete because we are in the realm of trading and we have a time limit on our trades to make money of maximum 60 days. A trade idea is not complete unless there are catalysts that are going to move the stock. Okay. And we build trade structures around these catalysts because we want to maximize our returns from the risk that we're taking. So we obviously identify catalysts, and we identify catalysts that are additional to publicly known catalysts like earnings announcements. Most of the time, we are structuring these trades with options. However, we do not take options positions unless they provide a marginal benefit to simply owning or shorting a stock. Okay, that's very, very important. That's also a thing that retail traders get very, very wrong. Professional traders will only take options positions if it makes sense to do so. We don't take options positions just because the options exist. Okay, we only do it if it makes sense to do so. Now, with all of these things in theory and trade structure in implementation, so fundamentals, timing, trade structure, and catalysts, that's all available in additional programs at ITPM via the PTM video series, the POTM video series, and the PFTM video series, which is in the Forex market and can be done much, much later. The core competency that you need to get is running equities long-short portfolios, because that's where you get the most consistency in terms of profitability over a long period of time. We also have risk management as part of the process. And that's split up into preemptive and reactive risk management. Now, preemptive risk management is also covered in our programs because these are preemptive rules that you put on your portfolio preemptive risk management rules that you transpose onto your portfolio to make sure that you can never blow up, or there's an extremely low chance that you will actually lose a significant amount of money. These preemptive risk management processes are pretty simple to understand, and they are available in additional programs at ITPM. Unfortunately, reactive risk management can never be taught in a video program, ever. Why? Because every position that you have is situational. When you end up in a situation where something has gone against you or gone in your favor, the actions that you take cannot be written down in a rule book. Why? Because it's a moving target. The world changes, things change, and you have to be able to react to the new information and take a probabilistic approach, okay? Where the action that you take, the probabilities are in your favor that it's a good decision, okay? And over many trades, over a long period of time, if you're taking solid actions and the probabilities are in your favor, and the probabilities will never be 100% or close to 100%, but they can be in your favor. If you're taking that approach over a long period of time, you will add a lot of value to your account, okay? Unfortunately, however, reactive risk management can only be taught in person. And the way we do that at ITPM is via mentoring programs. So on an ITPM mentoring program, your mentor will obviously be checking all of your processes, the quality of your trade ideas, the quality of your timing, the quality of your proposed trade structuring, and your identification of catalysts, your preemptive risk management, but also helping you with the actions that you take. Within reactive risk management, when something goes right, so you have a winner in your portfolio, or when something goes wrong and you have a loser in your portfolio. You can, of course, take your time learning the Pro Trader systematic process, the long short portfolio management process within the 60 days time horizon. You can, of course, learn that yourself, take your time and implement yourself. You can, of course, do that. But if you are struggling at any point, or you think you need to just take a shortcut and get better results quicker, then a mentoring program is there, it's available, and it can be taken advantage of. Now, in terms of the IPLT video series and understanding the differences between professional traders and retail traders, we came to realize very quickly, okay, that there's a genuine, real difference between the two. How retail traders and pro traders approach the financial markets. The most important thing for pro traders is to first understand the parameters of the industry that we're operating in and to strategize how best to approach the market within that industry. Retail traders don't do this, and they make all the dumb money mistakes and never ever learn from them. Professional traders never make these mistakes. We are on the other side of retail traders. We are the polar opposite, okay? Once we understand the infrastructure of the industry, we know how to become consistently profitable. How? Through volatility. It's the most important thing. We have to understand volatility after we've understood the parameters of the industry. Volatility always comes first. And then what do? We target the risk and reward opportunity that's available in the market. The market dictates the opportunities to us. Okay, we don't transpose a solid requirement onto the market to try and make a certain amount of money every day. We look at the volatility, we understand it, and we operate within those parameters. Okay, professional traders know that when we target a specific risk and reward, we have to have a robust and repeatable process in order to get consistency in returns from the risk that we're taking. And that is Sharpe ratio. Okay. So what do? We build long, short, 1 to 3 month time horizon portfolios. Okay. Retail traders lack this understanding. They lack the understanding of the industry infrastructure and conflict of interest, and they lack the understanding that the market dictates your opportunities and your risk, and that you need to operate within those parameters. Okay. Retail traders don't understand conflict of interest, don't understand the industry infrastructure, don't understand volatility properly. Okay. What do? Well, they end up doing everything that the participants of the infrastructure that have conflict of interest, they end up doing everything that those guys want them to do. Okay. And what is that? It's very short-term trading, so day trading, and additionally, going all the way on the other side of the time horizon spectrum, investing. Okay. So being the polar opposites in terms of time horizon, and never being in the most consistently profitable and volatile area, which is the 1 to 3 month time horizon, and knowing how to do that properly. Retail traders lack the understanding of the industry, lack the understanding of conflict of interest, lack the understanding of volatility. So what do? They default to doing it all incorrectly. Now, in terms of understanding and in terms of educational development within this industry, it's great to know on paper the differences between professional traders and retail traders and start to climb out of unconscious incompetence. But what does it look like? Well, we proved it to you. Okay. We proved it to you with a number of volatility processes. Okay. First one we looked at was calculating a distribution of returns. And video 2 and video 3, the downloads there, basically help you with, firstly, in video 2 downloads, the basic statistics guide, bringing you up to scratch, bringing you to a standard of understanding in statistics to enable you to really understand the processes that pro traders use. And then in video number 3, calculating a distribution of returns. And we did that over a number of time horizons. But firstly, we did it on the S&P 500 to dispel some myths. And we used daily data. And essentially, the data showed us on a very large count number the parameters that we're operating in as that we would be operating in as day traders. So essentially, S&P 500 day traders, whether it's in the retail world or the professional world, okay, just traders per se. If you were to go into the market and just become an S&P 500 day trader, we realized very quickly that it's a completely unsustainable strategy due to the numbers. And of course, go through the numbers, make sure you internalize this information. This is how you get out of unconscious incompetence, really understanding it. And then we started looking at high-low returns instead of open and close on a daily, weekly, monthly, and quarterly basis. But we did it over a number of different assets in the market. And what did we find? Well, we extended our time horizon from daily to weekly, monthly, and quarterly. And what we started to find was that there's genuine opportunities on a consistent basis within the 1 to 3 month time horizon. We prove this with numbers. And where are the opportunities that are wholesale? Where are the wholesale opportunities? Where there's a lot of opportunities where we can get consistency in returns. We can get the good returns and we get them in abundance. Where do they exist? Well, we found them in the mid-cap and large-cap equities area. But it's important from a educational development perspective that we come to a number of conclusions. And we look at all asset classes just to cement this and internalize it. And this is just information that will never change. This is historical data. It can't be changed. Therefore, the messages and the conclusions, once you've understood them and internalized them, they never change. Okay. It's just going to be something that's in your database internally. that you innately understand. Okay. So what conclusions do we come to? Well, sovereign and corporate bond instruments are not even an option for retail traders to get numerous wholesale opportunities and volatility to stand the best chance to get consistent returns. Clearly, equity indices are more volatile than both bonds and currencies. Okay. And even as volatile as the most volatile commodity and EM currencies. Overall, equities provide clearly more opportunity and risk with much bigger opportunity set. So we're looking at above 2,200 stocks versus currency pairs 20 to 25 and approximately about 10 non-volatile ETF instruments that cover bonds. What we also realize is that day trading opportunities at the equity index level and in currencies is massively over-exaggerated. Day trading and even weekly trading, say the S&P 500, NASDAQ, Dow, and currency pairs, is a futile exercise with the odds against you. The expected returns in day trading popular instruments are terrible historically, even when using high to low data compared to close data. When we extend to the 1 month and quarterly time horizons, and we go lower down the market cap hierarchy, the market cap chain, to mid cap and large cap single stock equities, we find that this area of the market provides multiple opportunities historically, and more than likely going forward to enable consistently high expected return. So these are our conclusions. And how do we get to these conclusions? Well, we use the method, okay? We use the method of volatility calculation, the realized volatility method, for calculating a distribution of returns. So that's one method that we've taught you, okay? You've now got this forever. You can apply a distribution of returns analysis on any asset as long as you can get the data and then come to your own conclusions. Another method that we used was the ATRP, the average true range percentage. And in video 5, when we did that, you'll notice that there's multiple files, ATRP files, underneath the video that you can download, which we utilized. One of which was the S&P 500 monthly average true range percent. And when we went through the method and calculated the ATRP using monthly data for the S&P 500, when we went through that, what we realized was that the volatility on a monthly basis for S&P 500 is pretty low. Okay. So again, we're assessing risk and opportunities here. Okay. And we realized with S&P 500 monthly moves based on a quarterly basis, over a 1 year basis, and then 3 years, 5, 10, going all the way up to 50 years of data. What we realized was that the opportunities and risk in the index level is very, very low. Okay. And in doing so, we obviously taught you another method, the average true range percentage method for calculating volatility. What we also looked at was the all-time average true range percentage for daily, weekly, monthly, and quarterly data across all the asset classes that we looked at for distribution of returns. Why do we do that? Well, we want to get an idea and a sense of the differences in the methods. So you learn both methods, you learn the differences, and you learn the conclusions. This is all available in the ATRP summary file. And then we compared them. So we compared average true range percentages with all data across the multiple time horizons and doing the same analysis on the same assets as we did for distribution of returns, but for ATRP. And widely speaking, generally speaking, we come to the same conclusions. What are those conclusions? Well, when we compare the ATRP to the distribution of returns across the asset classes and the instruments, across the multiple time horizons, we come to the same conclusions as when we analyze the distribution of returns data in isolation. Okay. What we realize is that in order to expose ourselves to multiple opportunities, even when we're using the ATRP calculation, okay, if we want to expose ourselves to multiple opportunities and consistent volatility, and therefore increase our expected return significantly, we absolutely need to increase our time horizon as traders from hours and days and even weeks to the monthly time frame. It's not going to be any good, however, doing this in areas of the market where we don't get wholesale and frequent opportunities to make the money. So where we get the volatility, okay? If we did that, we just wouldn't have a fertile hunting ground to maintain that consistency. Opportunities will simply dry up over time. When we extend the time horizon to 1 to 3 months, it has to be done in areas of the market where a trader has exposure to multiple frequent new opportunities. And again, that is the mid-cap and large-cap equity space. The method itself, the ATRP method, for retail traders, it's very, very useful. Distribution of returns can be a long process in the beginning until you get used to doing it. Going back or wanting to get a quick answer, ATRP, so going back to ATRP, is a simple and good enough and very useful measure for retail traders to gauge expected returns in a certain time period. However, if you are looking to go into the trading industry, if you're going to go into the professional side of the trading industry at an investment bank or a hedge fund, you absolutely need to learn how to do the DOR, the distribution of returns profile, and work out the odds for instruments, the probabilistic analysis. You need to work that out and know how to do it. You just have to do the work and learn that method. Okay. As traders, in general, we want to make money over time consistently, but we need to be adaptable to the volatility. We need to understand that our style of trading has to be flexible enough to go where the money is. Okay. Our objective is to make money, obviously, using our own money on a consistent basis. The money in trading and portfolio management has and always likely will be in the long short equity portfolio management space with a 1 to 3 month time horizon. And when we look at the volatility and look at the numbers using distribution of returns and ATRP, and we compare them, we have to look at building portfolios that are exposed to the 1 to 3 month volatility. And we have to do it in the fertile area of the market, the fertile hunting ground. In mid-cap and large-cap equities, that's where we're going to get an abundance of opportunities over time. Now, we did look at another measure of volatility on a single asset. Yes, we looked at implied volatility. So not just simply looking at realized volatility, the historical volatility, but working out and calculating an expectation of future implied volatility. And we did this in video 6 and video 7. Video 6, we have a nice download there for the volatility index, the S&P 500 volatility index, bringing you up to speed on what VIX hedges look like. That's a very important PDF to understand. Calculating implied volatility, way more important. This is going to be something that you will probably use for the rest of your life. And definitely if you're looking to go into the industry as well. Calculating implied volatility is very important for all traders. Understanding that calculation and knowing how to do it. Okay. But let's start with the VIX, interpreting the VIX and taking action as a trader. Now, when we did our distribution of returns analysis, when we looked at the daily historical data, So not the implied data, the distribution of returns method for the S&P 500, we know that a 1 standard deviation move occurs 79% of the time and not 68% of the time. That's because it's not normally distributed. Stock market data, historical stock market data, is not normally distributed. It is peakier with fatter tails. Now, using that as evidence, what does that mean? Well, it just means that as professional traders, we must seek to be portfolio managers around 80% of the time. And then the probability is that around 20% of the time, or a maximum of 20% of the time, that's when we're probably going to be short-term, so day and week traders, and not 1 to 3 month traders. So we have to understand that, and have to understand that we have to be in transition, okay? And when you even look at a VIX chart, you can see that 80% of the time, the vast majority of time, volatility is low. It's normalized. It's normal, okay? But a maximum of 20% of the time, the VIX actually shoots up. It goes up by a large amount quite quickly, okay? And we call this, when it's moving, transition. And we come to a number of conclusions here that as portfolio managers, when the S&P 500 index volatility, the VIX, is in transition and rising, we really should be looking at switching from being portfolio managers to more short-term traders and seek to take advantage of the short-term volatility. And then when the VIX is in transition and falling from a higher level, we are seeking to switch from being short-term, so day and week traders, to building long-short portfolios with a 1 to 3 month time horizon. And what we also learned was that as portfolio managers, the VIX volatility going up is a portfolio manager's worst enemy and a trader's best friend. Very important to remember that tagline. Volatility is a portfolio manager's worst enemy and a trader's best friend. Okay. Why do we say that? Well, because when volatility goes up and goes up quickly, for the same amount of dollars in your account as a portfolio manager, you are now taking more risk than you previously were, and you haven't even done a thing. You haven't taken any action. Okay. Therefore, it's the enemy. When volatility shoots up unexpectedly, or even expectedly, if you're not doing anything as a portfolio manager in terms of lowering your risk, if you're not taking any action, you are increasing the risk of your portfolio without actually doing anything. Okay. Then on the flip side, if you're a trader, if you're a very, very short-term trader, and you're a day short-term trader, and you're making hay while the sun shines because volatility is high, but now it starts falling, okay? If you don't do anything to become a longer term by extending your time horizon from days to weeks, days and weeks to months, if you don't do anything when that's happening and you're trying to get returns short-term out of a market where volatility is falling drastically, if you're not doing anything, you're kidding yourself, okay? You need to be switching to become a long-short portfolio manager in the 1 to 3 month time horizon. So you need to start building portfolios, okay? And again, this is 80% of the time being a portfolio manager, and in the minority of time, 20% of the time being a short-term day and week trader. But what conclusions do we reach here from analyzing the VIX? It's a useful gauge. What it does initially when we're in the educational development phase, it really solidifies again what we learned in the distribution of returns analysis and the ATRP analysis. So when we've calculated realized vol, it confirms what we've actually the conclusions that we've actually arrived at. Okay. that we need to be in this 1 to 3 month time horizon the vast majority of time. Okay. And day traders and weekly traders, they are in the minority of times where they're going to be making money. Okay. They're going to be making money and getting wholesale opportunities to make money maximum 20% of the time. It confirms again that we're probably going to have to switch, okay, between the two. We can't just be completely dogmatic on one side where we say we're just long short portfolio managers all the time. VIX data historically proves as well as distribution of returns data analysis and ATRP analysis that we have to have the ability to switch, okay? So again, when the VIX moves up aggressively, up or down, we can use this as an indicator for shifting our approach. And we can transition from being portfolio managers to traders and traders to portfolio managers. So when the VIX is in transition, we are in transition. However, it does come with some caveats, okay? Everything is situational here. There's no rule book, okay? You can't sit down and read the 10 rules of trading, stick to it forever, and become wealthy, okay? Everything is situational. We still have to interpret what's actually going on at the time before we take any required actions. And the actions that we take as traders must be reactive at the time. It is more beneficial if we trade the positions themselves or we buy options versus outright hedges, okay, prior to a VIX move. That's also very important because the hedges, as you're going to find out when you properly sit down and read the PDF on VIX hedges, the hedges are perceived to be good in the market, but the reality is that they're nowhere near as good as hedges as people think. What we have to really be doing is putting on hedges if we want to have them in our portfolios in the first place, or if we even need them, because we are long-short portfolio managers. Most of the time, you won't need them. But if you are required to have some sort of hedge in your portfolio, it's much better to go for outright options or simply just trade the positions themselves. So reduce the size of those positions that you think are going to have a detrimental effect on your returns if the VIX goes up a lot. In terms of the VIX hedges themselves, much preferable to either just trade positions or trade outright options on positions that you've got in your portfolios. But if you absolutely have to do it, timing is extremely important. As you'll realize from reading the VIX hedges PDF, timing is very, very important when you're putting on VIX hedges, but we'd rather you not do it, okay? In terms of further conclusions, understanding the VIX properly to take a more professional approach is absolutely crucial. When volatility moves up aggressively and the market falls, long-short portfolio managers massively outperform on the way down. It's our job to do so, okay? We are absolute return. We want to make money when the market goes down. And when volatility moves aggressively down and the market begins to bottom and the market rallies, long-short portfolio managers who choose to build portfolios with a higher level of risk in their portfolio than the market risk, we outperform on the way up. We are absolute return mandate. We make a lot of money on the way up. That's our aim. We make a lot of money on the way down. That's also our aim. Now, with the method itself, calculating implied volatility, we did that in video number 7, utilizing the implied volatility calculator. Obviously, that's a download that you can get under video 7. Now, why is it useful? Well, of course, you can go online and there's a lot of sources out there where you can get implied volatility numbers from those publicly available sources. However, it's a useful exercise because you can check if the implied volatility numbers are actually correct. So it acts as a head check mechanism. Okay. Don't just go on publicly available sources of data, so information websites, forever, and just trust that all the numbers are correct, that the information provider, the vendor, has calculated everything correctly. If you want to be standing on your own 2 feet as a trader, you need to know all of these methods. And from time to time, or all the time, you need to check if numbers are actually correct. Okay. Secondly, if you do have any ambition to go into the professional side of trading, this is unavoidable. Okay. It's all about volatility, and there's a lot of sophisticated processes that go on the professional side. Okay. If you want to be on the professional side, you need to learn how to calculate implied volatility. Either way, guys, it's just a very, very useful measure. It's a very, very useful tool to have. Once you know how to do it, keep practicing. You can do it yourself forever, and you won't have to rely on anyone else or any third party to do the work for you. Now, if you recall, Chris Quill went through a very useful exercise calculating implied volatility on some mega caps and some mid caps and comparing it to the close-to-close standard deviation data. He looked at Microsoft and Alphabet, Google for the mega cap examples, and for the mid cap examples looked at Trex and Ollie. And you can see it confirms our views again. The data is very, very similar when we look at data across daily, weekly, monthly, and quarterly timeframes. So by doing the exercise, we obviously learn a new tool. We learn how to calculate implied volatility, but we also learn that our analysis earlier with realized volatility, it confirms all of our previous views. Okay. Implied volatility, another method that confirms all of our previous views, and we come to the same conclusions. Next, we looked at portfolio volatility. And again, in video 2, the basic statistic guide, this will help you with video number 9, where Chris looks at portfolio volatility and teaches you how to calculate portfolio volatility properly. Okay. The basic statistics guide, you will learn the basics of variance, covariance, and correlation. So very important to brush up on those skills and understand that to really appreciate what video 9 is all about. Okay. Now, with portfolio volatility, the method is obviously, and the concept is obviously different to what we were looking at earlier. Why? Because what we've looked at up until now, in terms of methods and conclusions, it's really all on single assets. And portfolio volatility is based on the premise that we're not just looking at volatility for single assets. We're looking at the volatility of multiple assets taken together, which is the definition of a portfolio. So it stands to reason that if we can calculate the volatility of one asset, we can calculate the volatility of a portfolio. Okay. Because as long as we can get the data, we can figure this out. What's important is expected future portfolio volatility. We use statistical methods to forecast the potential future expected volatility, so the risk and opportunity of a portfolio, which is just a collection of assets. Okay. We can use the historical asset prices, so the data that we download, to calculate our expected future volatility by working out variances, covariances, and applying weights for each stock in the portfolio. Covariance measures the relationship between two assets, and correlation is simply covariance normalized with a value of +1 to -1. Okay. And it can also be expressed as a percentage value, +100% to -100%. Now, why is it important to know how to do this method? Why is it important to understand it? And make it be part of your life going forward? Well, we can model different types of portfolios. So portfolios with different levels of volatility, so risk and opportunity, and with different correlations. Okay. When we do this, we can get a much better understanding of what portfolios look like in terms of risk and opportunity. And we can choose as traders and PMs what risk we want to take, where we want to be on the risk curve, and what expected returns we want to target. Okay. What risk are we targeting? What returns are we targeting? And we're doing it going in with eyes wide open. We're not going into the market blind and not knowing what our risk is and not knowing what our expected return is. We go into the market knowing what we are doing with a firm strategy and a proper plan. And we go into this utilizing a sensible approach given our requirements. Okay. Given our requirements as traders, portfolio managers, we go into it with a sensible approach. We understand that in portfolio theory, diversification is useful, but it's only useful to an extent. When we diversify away our risk, that is desirable. But what is undesirable is diversifying your risk out so much that you can't get a high expected return. So we have to consider this parameter. Okay. Now, part of the reason why we approach the market with a long short portfolio mandate is because it lowers the portfolio volatility. This can be a good thing. This is a nice thing to have. Okay. But we have two competing factors that we have to consider. We have our desire to get outsized absolute returns. We also have our desire to control risk. And these are two competing factors. So what we have to do as traders is take a sensible approach. Okay. We choose the level of annual risk that we want to take, and we target an annual expected return from that risk. That is Sharpe ratio. Okay. We aim to get the highest amount of return possible from the lowest amount of risk possible. So to maximize the Sharpe ratio and make money regardless of whether the market goes up or down. So we still have the absolute return mandate. And we still, however, always want to be doing way better than the stock market returns if we ever did desire to measure ourselves against the stock market. Okay. Which in general we don't. Okay. So in terms of diversification and in terms of weightings that we have in our portfolio, for retail traders with small levels of margin capital, so we're talking 25, 50 to 100,000, you're looking at 8 to 12 positions. With retail traders with larger amounts of capital, so 250, 500, a million, we're looking at 10 to 14 positions. And very large retail traders, which are on professional levels of margin capital, we're looking at $2 million to $5 million on margin. We're looking at 12 to 16 positions. Now, when we are looking in the US and we're looking and considering US equity long short options portfolios for both small retail traders and larger retail traders, so $25,000 to $2 million margin capital, we're looking at targeting certain levels of risk and return. Okay. And we're looking to leverage by a certain amount. So what are we looking for in terms of the annual portfolio volatility that is in the underlying portfolio? Not with the options positions, but the underlying stock positions. Okay. If we model the portfolio, what expected annual return are we looking for in the underlying stock portfolio? We're looking at somewhere in the range of 15 to 30%. Okay. Remember, this is in a long short context as well. When we're using options, we are utilizing them to get implicit leverage of 3 to 10 times that number. So the range of possible outcomes from that volatility in the underlying stock portfolio is 45 to 300% annual return. Realistically, we're looking at targeting 50 to 100% annual return when we're utilizing equity options. So what does that mean? It means we're getting a 3.3 times return on the volatility of the underlying portfolio. So that means our Sharpe ratio is 3.3. Now, of course, these numbers can be higher. The returns can be higher, but we're just being as realistic as possible here. We're not looking at this and saying, I want to make this exact amount. We're looking at ranges and we're trying to fall in those ranges realistically. Okay. In terms of portfolio correlation, we're targeting a positive 0.3 to negative 0.3, somewhere in that range, but we're likely to be around 0 with a small positive most of the time. Now, remember, this is in a long-short portfolio management equity options context. It's regardless of the equity market going up or down. Now, in the rest of the world with equity CFD traders, contract for difference traders, we're looking at small and large levels of margin capital for retail traders again. And we're looking at exactly the same expected annual portfolio volatility of a range of 15 to 30%. However, now with CFDs, we're using direct leverage, not implied leverage through options. So with CFDs, typically we're looking at 4 times. So the range of possible outcomes on that volatility is 60 to 120% annual return. However, realistically, we're looking at between 22.5% and 45% annual return and targeting a minimum of 1.5 times portfolio volatility in terms of return. So we're looking at a Sharpe ratio of 1.5. And again, the correlation is the same. This is regardless as well of the equity market going up and down, because we still have the long short absolute return mandate. Now, the reason for the returns, the expected returns, what we're targeting, the 22.5 to 45 being lower than equity options, is just the difference in the direct leverage and the implied leverage. You can get a lot more leverage through options on average over many trades over a long period of time versus CFDs. Okay. And again, remember, options change the risk profile of the portfolio relative to CFDs, relative to outright naked long short. Now, if we look at exactly the same portfolio, but we apply it in the US and we just have a long short stock portfolio in the US because CFDs are not available to trade in the United States. So we're looking at exactly the same portfolio, 15 to 30% expected annual volatility. But in the US, because CFD is not available, we only get 2 times leverage, so 50% margin requirement on the same portfolio. So the range of possible outcomes is 30 to 60% annual return. Therefore, we have to get a better Sharpe ratio. We have exactly the same correlation. That's a given. So we're doing the same portfolio, but with 2 times leverage. We have to have a higher Sharpe ratio, which means we have to be much better traders in the US to get similar returns. So guys, we've come to the end of the IPLT video series. It's been a long slog. I'm sure it's been a lot of good information for you, but also I understand it's probably been a long, hard slog for you guys, taking in all this new information. And there's still a lot of work to do. A summary of the key resources in the video series. So PDFs, you've got the basic statistics guide. You've got the VIX hedges PDF as well. Key spreadsheets for an introduction as to how professional traders do things. It's all about volatility, guys. All about volatility. So you've got the 4 main files there, distribution of returns, multiple files on that, multiple examples. You've got the average true range percentage calculations, multiple files there as well, multiple examples. You've got the implied volatility calculator method, and you've got the portfolio volatility calculator method. That is a fantastic introduction as to how professional traders actually do things. If you familiarize yourself with all of this information and you can learn it and internalize it and understand and keep these processes going in everything you do, you're definitely making huge progress. As retail traders learning this stuff, if you can internalize it, learn it properly, and use it regularly, you are way ahead of the vast majority of retail traders on the planet. Okay. Now you've got to remember, these are methods and processes that are timeless. Okay. You can 10 years from now use this. You can use this 30 years from now. As long as you can get the data, you can go through these processes and understand the risk and opportunity in an asset. Okay. And you can build and model portfolios in the spreadsheet correctly. Okay. Very, very useful stuff for multiple reasons, but the main reasons, absolutely knowing the differences between professional and retail traders, raising your game to the standard of professional traders by learning the right information, internalizing it, and applying these processes forever in your own trading in the retail trading infrastructure. Okay. This is how you do it. And this is why it's totally useful for everybody. So you are now entering the level of conscious incompetence and leaving the level of unconscious incompetence. You've now got your hands on the right information, which demonstrates to you the evidence is literally right in front of your eyes. It demonstrates to you that what you were doing before was all totally wrong. You have the right information. What else is the right information is additional video series at ITPM. You know, what we've done here is an introduction to professional level trading. So what's next? Well, you can take the PTM video series to learn the professional trader processes for trade idea generation, timing, trade structuring, building portfolios, and for preemptive and reactive risk management and trader metrics with track record management. So we take you through the entire process: trade idea generation, the timing of trades, the trade structuring of trades, portfolio building, and preemptive risk management. We go over some points in reactive risk management, but obviously that is far better to get experience with real money, trading real long-short portfolios. Unfortunately, you can only take it so far in theory, but also we go through trader metrics and track record management. Okay. Specifically for trade structuring, if you want to go to the next level, okay, take the POTM video series, the Professional Options Trading Masterclass, specifically learning about options and going deeper into trade structurings. So using options to structure trades, using calls and puts. Why is that important? To get a better ROI, return on investment, on your trade ideas and your portfolios, and to bring asymmetric risk reward into your portfolios, and also to become much more agnostic in your timing and risk management. That's something that can only be covered in the Professional Options Trading Masterclass. Additionally, we do have a program in the Forex market. This is something that is not a core skill set for professional traders, professional portfolio managers, but it's something that you can bring in to your analysis and to your portfolios later, a little bit further down the line. Now, why do professional traders not really focus too much on opportunities in the Forex market? Well, it's because the opportunity set is way smaller in Forex than in stocks. As we looked at earlier, we looked at around 20, 25 being the opportunity set in terms of Forex pairs. relative to 2,200 plus stocks in the stock market. Getting consistent profitability out of that opportunity set is very difficult. Professional traders more look at the Forex markets as indicators and for macroeconomics, but occasionally there are some big opportunities. So not a core skill set that's absolutely required, but will broaden your education and will provide some big opportunities occasionally. What you really have to be doing is focusing on the core skill set of professional traders, which is long-short portfolio management in the 1 to 3 month time horizon in mid-cap and large-cap equities, and leveraging your positions with options. That is the core skill set, okay? PFTM can be done later down the line once you become competent trading the most volatile asset class, which is stocks, and becoming consistently profitable in the 20 to 60 day time horizon, leveraging your positions with equity options. Now, if you struggle with the core competency, if you are struggling to become consistently profitable with long-short portfolios in the 20 to 60 day time horizon, if that's the case, or you just want to develop quicker as a trader, okay, then a mentoring program is always an option. So a mentoring program with one of our mentors at ITPM. Now, you still have to put in the work. Although your development can happen quicker, the mentor is sitting on your shoulder. They are analyzing your trade ideas. They are critiquing your timing, your trade structuring, how you're building portfolios, how you're preemptively and reactively risk managing, and also managing your stats, your trader metrics, and your track record with you. You still have to do the work. So you can develop quicker. We can get you to become consistently profitable, but we need, on a mentoring program, always for you as the student, as the mentee, to be putting in the work. Why? Because you need to be able to stand on your own 2 feet. After a mentoring program, guess what? You will still be on your own, okay? You need to be able to rely on yourself. So yes, we can get you up the curve quicker, but it's not a shortcut per se, okay? You still have to put in the work. So guys, these are the suite of courses at ITPM, and additionally, mentoring. Consider PTM, POTM, PFTM, and possibly a mentoring program. That's all totally fine. It's all there available for you to take advantage of and continue your educational development to becoming a competent trader and pushing as hard as you can to become unconsciously competent. Okay. We want to be the autopilot trader all the time. That's what we want you guys to be. Okay. This is the whole aim of what we're doing. So guys, let's go back to the desk for some final words.
Okay, guys, so you have made it to the end of the IPLT video series. Well done. It's not easy. I know trading is tough, but you've got to tough it out and do the work. We started out at the beginning of the video series with an objective to make you a consistently profitable retail trader by utilizing the same approach as professional traders. You've seen the pro trader systematic framework when we were going through the IPLT video series. And within the IPLT, you've seen some very important things. So you saw the 3 parts of the IPLT video series, which are so important to climbing out of unconscious incompetence and climbing the competency hierarchy. Those 3 parts are as follows: knowing the difference between pro traders and retail traders, That's first and foremost the number one thing you have to start with. Number two, understanding the landscape of the industry, and then using that knowledge of the landscape and how it works, how the industry actually works, to your advantage. Use it to your advantage. And three, understanding volatility and applying volatility measures constantly in your trading. They're the three areas of the IPLT video series, and they are the most important areas to get started to get you out of unconscious incompetence and get you up and climbing the competency hierarchy. But remember, this is just the beginning. As mentioned previously, the clue is in the title of the video series. It is an introduction, guys. It's an intro. The Pro Trader Systematic Framework, you will have noticed there's many areas to it. So you now have to learn, if you choose to go forward and continue raising your competency to the pro level, you need to learn trade idea generation, which is rooted in fundamentals. That's the PTM video series. Second, trade structuring. That's the options trading masterclass, the POTM video series. Preventative risk management. That's both the PTM and the POTM video series. And you have to trade live. Yes, guys, trading requires money, and you actually have to trade with real money to become good at trading. You can't get to the pro level just with understanding. You have to actually do it. So you have to do it and learn reactive risk management and do it for real. So I strongly advise that if you want to keep going and keep going up the competency hierarchy, that you engage yourself and become good at this. It's one of the best skill sets you can ever learn, ever in your life, okay? And if you do it right and you apply yourself and you stay focused, it can probably pay for the rest of your life a lot, okay? It will pay a lot if you stay focused and you do it properly. Now, we have a little matter of an examination for the IPLT video series to deal with. Like all exams at ITPM, it's a multiple choice exam, and the IPLT exam is 30 multiple choice questions with a time limit of 60 minutes. Additionally, please bear in mind that once you have actually answered a question, you can't go back to change your answer. You have to keep moving forward through the exam. So once you choose it, you can't go back, okay? Now, also, don't worry. There's nothing in the exam that's not in the IPLT video series. You are simply testing your knowledge to see if you've digested the information and it's internalized and you understand it. Now, in terms of marks, below 50% is a fail. Between 51 and 59% is a pass. 60% to 75% is a merit grade, and 76% plus is a distinction. You will get a certificate at the end of the exam with your mark on the certificate, and you're also going to get a PDF with text on it that describes what you've actually learned on the IPLT video series, and you can cut and paste this text and you can put it on your official resume. So when you're applying for jobs, and you can actually put the text onto online professional networking sites as well. Now, when you actually apply for jobs, you can also put on your resume, on your CV, you can put the Institute of Trading and Portfolio Management and me personally as a reference on your resume and CV. Later down the line, if you are offered positions, full-time or part-time positions in the industry, in the trading and portfolio management industry, part of that process, when you go through joining a company, they will actually have to verify via referees on your resume that you actually did what you said you did. If you put me down as your referee and what you did at ITPM, and this goes for not just the IPLT video series, it goes for all online programs and mentoring programs at ITPM. If you put us down, when the companies contact us, we will write you a reference, okay? So you can put us down as referees. So guys, that's it. That's the IPLT video series done. If you need, you can go back over all the videos again before you take the exam, or you can actually take the exam, and if you want to reference the videos after, they're going to be there available for you. Keep practicing everything that you've learned here in the IPLT video series. Please do so. Don't just do the video series and in a few months' time, forget the information and don't use it in your daily, weekly, monthly processes. You should absolutely use it. Keep practicing and keep using the information in your trading on a constant basis. I promise you, it will make you a better trader. You've now come out of the level of unconscious incompetence. But remember, there's more work to do. And if you choose to do it, you will see in further video series the information that we've got at ITPM. It's absolutely outstanding. And also our mentoring programs, when you're trading live with our mentors with real money, they are also absolutely amazing. So guys, that's it from me. Have a great time in the exam. Make sure you get a good mark, and good luck with everything. Good luck with your trading, and see you soon at ITPM.